Hi, I'm Astrid. Welcome back to ADHD Investing Ideas. Today, we're doing something special. A full cinematic tribute to one of the most talked about high-yield powerhouses in the income investing world, ULTY. Love it or hate it, the numbers, the volatility, and the massive cash flow have completely rewritten the playbook on high-octane covered call funds. We're breaking down the journey, the mechanics, and the relentless cash machine behind the ticker. We hope you enjoy the video our team created. If you want to tweak the tone, whether you want it more cinematic, mysterious, or data-focused, let me know.
February 28, 2024. This date marked the launch of an aggressive, options-driven fund designed to thrive on market volatility. This was the inception day for the ticker ULTY, which listed on the exchange at an initial price of $20 a share. Most income investors look for a quiet parking spot for their cash. They choose stable funds with the expectation that the share price will stay flat or rise slightly while they collect a small monthly check. But treating a high-yield volatility fund like a traditional savings account leads to a predictable result. If the goal is price stability, the decay inherent in unhedged option strategies will eventually erode the principal. The results looked catastrophic. ULTY's share price followed a relentless 87% downward arc. However, green bars show it never missed a weekly distribution. Critics called the collapsing price a yield trap going to zero, assuming investors would use a dividend reinvestment plan to recycle their shrinking capital. While the critics focused on the total return of the fund itself, they missed the logic of the distributions. They never accounted for what happens if that cash is moved somewhere else. Whether this investment succeeds or fails isn't determined by the chart of the fund you buy. It's determined by where you route the cash that the fund produces. The strategy begins with a strict rule. Not a single cent of the yield is ever reinvested into the original fund. Every week, the options premium is stripped out of the Tier 1 engine. It travels through a one-way pipeline, immediately used to purchase shares in a secondary asset. This Tier 2 destination is QQQI. This fund provides tax-efficient exposure to the NASDAQ 100, acting as a preservation layer that turns the raw volatility of the first tier into a stabilized index-based income stream. This mechanical extraction ensures that unhedged market panic is constantly converted into disciplined cash flow. You are harvesting the volatility of the first asset to build a position in the second. The waterfall doesn't stop there. The monthly distributions generated by the Tier 2 index fund are then funneled into a third and final layer. This Tier 3 asset is SPMO, which tracks the high-momentum leaders of the S&P 500. At this stage, the original volatility has been fully transmuted into broad market equity that compounds independently of the first fund's price. Within 8 to 12 months of following this routine, a specific mathematical milestone is reached. The total amount of cash extracted and moved downstream equals the original capital spent on day one. This is cost basis zero. It means 100% of the initial principal has been recovered and secured. The investor no longer has any personal out-of-pocket capital at risk in the market. Crossing this threshold changes the math of the entire portfolio. Since the initial investment has been returned, the system now continues to build the QQQI and SPMO positions using only the profit generated by the market. By December 2025, the fund's price erosion led to the announcement of a 1-for-10 reverse split. For most speculators, a reverse split is a signal to exit. They see the share count drop and the price reset, and they interpret it as a final confirmation of the fund's failure. The architect of an extraction system ignores this panic. They continue the same automated weekly buys established at inception, treating the split as a nominal adjustment that doesn't impact the flow of cash. A falling share price or a reset in share count doesn't stop the waterfall. As long as the fund produces a distribution, that cash continues to buy shares in the downstream tiers, where the principal is safely locked away. By prioritizing the extraction of cash over the price of the vessel, volatility stops being a threat. It becomes the fuel used to accumulate a permanent portfolio of index equity, paid for entirely by the market's own movements.